The European financial system is getting defensive. Banks over there are doing some interesting things, not unlike their American counterparts. Lending is down practically to everyone across the board except for one specific class of borrower. And when that specific class of borrower starts to hit up European banks for loans, that's not a good sign. And that signal isn't specific to euros or Europe. It's another one of those shadow Eurodollar indicators. Now, we've got to review a little bit of history first so that we can calibrate our analysis and understand what this new data means. But in order to get to the bottom of what's going on here, we've got to go a little bit further into the European shadows, which we'll do in just a moment. But I want to remind you first, Eurodollar University is having its spring sale. For the first time, we're offering 1 month for free on both the membership and the daily briefing. If you ever wonder what those are about, here's a chance to check it out on us. Cancel anytime in the first month, no risk to you. We've also got tremendous deals on annual rates for both of those, as well as the deep dive analysis. And just so you know, what we're going to talk about today comes directly from a deep dive analysis. Tremendous prices on everything, all the information at our website, eurodollar.university. So to start on our review of European banks and what's going on, we got to do a little bit of jargon and historical review. The jargon first. We're going to be talking about MFIs, or that's how they classify it over there in Europe. These are European Central Bank statistics on the European banking system, which includes and what starts with what are called monetary financial institutions, which is an entire class of banks and credit institutions and a bunch of other things too. What we're specifically interested in is one single loan item. It's called loans vis-a-vis Euro area financial corporations other than MFIs and ICPFs reported by MFIs, excluding ESCB in the Euro area. That's a lot. There's a mouthful there. Let's unpack it first before we get into this. So these are loans made by MFIs or monetary financial institutions. Think of them as just banks making loans in Europe, but they're not just any loans. They're loans to Euro area financial corporations that are not banks, so non-banks in Europe, nor are they ICPFs, which means insurance companies and pension funds. So these are non-banks that are not insurance companies and pension funds. And the last part, excluding the ESCB, we're just excluding the European system and the central bank transactions too. So these are loans from European banks to basically non-banks. Things like investment funds or potentially securitized structures, those types of things. Now this also includes, if you look through the ECB's manual on the statistics, financial corporations, excluding MFIs, comprise non-money market fund investment funds, OFIs, which are other financial institutions. You gotta love these labels. Financial auxiliaries, captive financial institutions, and money lenders, insurance companies, and pension funds. But as we said about the last two, those are not part of this lending item. It also includes CCPs, which are central clearing houses and central clearing counterparties. But I doubt that's what's really going on here. And I only bring that up just to cover all our bases. I don't think they're the ones who are lending, or there's not loans coming from European banks through CCPs to the others. I don't believe that's the case. I think what we're really focusing on here is European banks lending to non-banks, investment funds, and I believe securitization structures, which I think is the most important thing here. Now we look at the lending data. Loans, as I said in the introduction, they're down across the board, except for this one category. So it's not like the European banks are just expanding their balance sheet and just throwing off some liquidity. It is literally this one specific class that is getting more loans from European banks. And it would make sense if some of these banks are sponsoring some of these structures. That's why they're lending more and more to them. Because when you go back through history of the specific item on European bank balance sheets, it tends to rise during the most difficult liquidity and economic financial circumstances over the last 15 years. So let's do that review real quick so you can see exactly what I'm talking about. We'll go back, of course, to 2007, specifically January 2007. This is when the term subprime first came out into the public lexicon. There were some rumors about Bear Stearns hedge funds, high-grade hedge funds, having some liquidity issues. And in the European banking data, what you see is that previous to January 2007, there was an increase, a pretty steady increase in European bank lending to these non-bank institutions, whatever they may be. And that was likely more just so the regular operating practice, though there was some slowdown in 2006 as the housing irregularities started to become, no, really the dollar shortage symptoms started to become more and more apparent. But suddenly in January 2007, really January through April 2007, when Ben Bernanke was talking about subprime being contained in front of the US Congress, suddenly European banks are lending a lot more and a lot more aggressively to these non-bank financial corporations. So you have an annual year-over-year rate of around 10% in early 2007 that surges to 25% year-over-year by January 2008. And then it slows down in the summer of 2008 for what should be obvious reasons. By then, banks are saying, we don't want to do anything. We were somewhat optimistic that we could get through this thing and provide liquidity backstop to some of these non-banks, but summer 2008, we're just going to close everything down, which is kind of what they did. But what that shows is that European banks are going to lend more to non-banks during periods which are more like liquidity, systemic events. That's what we're looking for. So the loans from European banks to these non-banks increase during periods we identify as problematic in terms of money, finance, and liquidity. That was true again to the next part, which is Eurodollar number 2. And Eurodollar number 2, maybe contrary to popular perception, really started to show up almost immediately after Eurodollar number 1 had ended. We started hearing things about Dubai and Greece and some other of the southern European countries and their government debt, their sovereign debt, as early as November and December of 2009. And sure enough, what do you see? In this specific item, European banks begin lending more aggressively to these non-banks. In November and December 2009 together combined, lending from banks to non-banks increased by 6.6%. That's not an annual rate, that's raw total. And then it happened again, March through June 2010, 7.4% in just that small period. And remember what happened during that period. That includes May 2010, which was not just a flash crash on Wall Street, if you remember that, was also the Greek crisis erupting, which is really about repo. But essentially, liquidity problems, we see the symptoms of them, and this is one angle behind all of it. It continued throughout the rest of Eurodollar number 2. There was quite a lot of volatility back and forth in the specific lending through the end of 2010 into the first half of 2011 as Eurodollar number 2 more fully develops. But then summer of 2011, we've talked about this before, August in particular, full-blown eruption in liquidity crisis around the world. And sure enough, July to November 2011, you see a almost 5% increase in European bank lending to non-banks. And these non-banks are simply scrambling for liquidity. They're borrowing from European banks because the liquidity situation, the funding situation in the rest of the world, the hidden shadows of the Eurodollar system, is becoming increasingly difficult. These non-banks don't have many liquidity recourses. One that they do have is drawing on some liquidity backstops and lines of credit with some of these banks, including what we're seeing here. There's probably more to it than just that. But essentially, non-banks are telling us we're having funding difficulties out there in the real world. Therefore, we have no other alternative but to go to the local European bank and say, hey, can we have some funding? And for reasons that aren't clear in the statistics here, these European banks at first are willing to give them the credit that they need, at least in the short run. That was the case in Eurodollar number 1 as well as here in Eurodollar number 2. And it would come back in one of the most unappreciated, if not completely, totally unappreciated episodes in recent history. That's Eurodollar number 4, 2018. And it started right away. In January 2018, European bank loans to non-banks increased by 9.4% just in that one single month. And a lot happened in January 2018 that showed the Eurodollar system was experiencing substantial problems. Not only was there a massive economic setback, especially in places like Germany, there was also a ton of financial indications, including the falling US dollar exchange value. Remember 2017 globally synchronized growth? Everybody said the dollar was toast, it was heading lower. And suddenly, January 2018, that decline in the US dollar exchange value suddenly stopped. The dollar turned around and went higher, surprising pretty much everybody. But essentially, we see the same signal. Liquidity problems, and this line item on European bank balance sheets goes up. And it would happen again during one of the most infamous episodes, at least for Eurodollar University, most infamous liquidity episodes of the last more than decade. And that's what we call the landmine. Sure enough, between October 2018 and April 2019, as curves were going crazy, financial markets were upset, officials couldn't figure out what was happening, we see an 8.4% increase in European bank loans to these non-bank entities during the landmine. We'd see it again in March 2020 for pretty obvious reasons, where the balance of loans outstanding increased by 6.4% just in March 2020 alone. So again, it establishes the precedent here. Non-banks in Europe go to European banks when the funding markets overall, the wholesale markets, maybe including repo, collateral, all that stuff, when it becomes very difficult, they search out European banks for one last opportunity to continue their operations, to maintain their funding levels for the next little while. And European banks, as I said, continue to oblige them for a variety of reasons. Not necessarily just because it seems to be good business or that the European banks want to take some additional risk. In more recent times, we saw this in early 2022. In fact, January, February, March, and April. Not only did we have the supply shock and the effect of consumer prices, more importantly, you had the Russian invasion of Ukraine, which triggered a whole bunch of financial and funding volatility. So here come non-banks back to the European banks saying, we would need additional funding. And sure enough, there was a large increase, about 12% from January to April of 2022. Again, lots of stuff going on. That's when we got the first inversions in yield curves in U.S. Treasuries. A lot of things happened. Fears over the European system, the entire European economy going to be subjected to a massive energy crisis. All of that. And here we see another warning sign in the specific bank item. Now, that continued on until September 2022. Of course, the crisis in September. There was actually a pullback here in October, but then an increase in November, continuing the same pattern. There is one notable exception, and that was last March during the banking crisis, which included the big bank in Switzerland. We did not see non-banks go to their bank counterparties and say, we need more funding, largely because this was more of a banking issue than it was necessarily a non-banking issue. But still, that's an exception to what we're saying is almost like a rule of thumb here. In the most recent estimates, which came out just yesterday from the European Central Bank, the total amount of loans between European banks and these financial corporations, these non-MFIs, was over 1.3 trillion euros. So this is not a trivial amount. This is a big, huge amount of loans going back and forth between banks and non-banks. And that has risen 6.6% year over year, a 5.7% increase since last August. During the same period, we're seeing rising difficulties, the shenanigans in U.S. banks going on here, changes in the yield, big bond rally, all of it. Going back to last fall, suddenly a huge increase, a substantial increase in European bank lending to non-banks. As I mentioned, banking overall in Europe, lending overall in Europe has been flat to lower since September and October 2022, which makes sense. It's not about rate hikes in Europe. It was about the liquidity crisis and banks becoming more and more defensive. So bank lending overall has been flat to slightly lower. And you can see lending to households has been a little bit lower, especially more recently. Lending to non-financial corporations, there's been even less of that, which is analogous to in the United States, so U.S. banks are cutting back on their commercial and industrial loans, a cyclical indicator. But overall, lending is declining across Europe, if at a gentle, shallow rate like the economy. It's been flat to lower for about a year and a half now. So suddenly along comes these non-bank institutions saying, we want some loans from European banks, and of course European banks are obliging them. At the same time, they're acting defensively everywhere else. And of course we have all these other signals that goes along with it. This is a warning sign. But what is it about? What is specifically causing non-banks to borrow and get funding from their European banks? That we can't know for sure, though there are some clues. First of all, Europe does have a commercial real estate problem. It's not necessarily as big as the one we have or that we're facing here in the United States, and of course there are some spillovers and spillover risk and some crossovers here. But as far as European commercial real estate goes, that's a big issue. It's debatable about exactly how big. Just last year in November, the European Central Bank put out its financial stability report. And unfortunately, that's the last one. We won't get the next one until May. And in their financial stability report, where it came to commercial real estate, they said real estate firms are particularly vulnerable to losses in light of the ongoing downturn in euro area commercial real estate markets. In an environment of tighter financial conditions and financing conditions and elevated macro financial uncertainty, I think those are the keys there. We're not talking about rate hikes. Commercial real estate prices have continued to decline, with a subdued market activity hampering price discovery. So it may be just like in the United States, European banks are attempting to handle this commercial real estate problem by continuing to forward liquidity to non-banks that are maybe exposed to commercial real estate and some other risks too, those macro financial risks. That's a big one too. So maybe it's European banks supplying funds to non-banks to just keep everything hidden back in the shadows. But at the same time, what's indicated here is that non-banks are finding it more difficult to find funding that isn't from a European bank loan. That's the key takeaway. As far as the European economy goes, talking about macro risk, got some more ugly statistics from especially Germany. Retail sales were down really big in February. I mean, real big in both nominal and real terms, suggesting the European economy itself is not accelerates. The recession continues to go forward and maybe actually accelerating to the downside. Despite hopes for disinflation and the looming prospect of rate cuts, maybe this is the reason why the European Central Bank, among most of the majors, is in such a hurry to cut rates. They realize what's going on here, at least partially realize what's going on here, as well as the real risks if things continue to move in this direction. The economy continues to get worse, and maybe there's some financial and funding irregularities bubbling up from underneath the surface, from out of the shadows. So what we do know is that banks in Europe, they're not lending to anyone except for this one category of borrower. And this one category of borrower, when it starts to borrow, that's never a good sign. And it's not a good sign just about European non-banks or European banks or the euro area itself. It applies far more broadly. It's a signal of systemic tightness across the entire monetary system. Now, while this does not represent something we need to be panicked over right now, what it does suggest is we need to be paying more closer attention here. It does indicate somewhat of an escalation from last fall, timed and synchronized to a whole bunch of other indications too. So there's a compelling case here for more scrutiny and more attention. What is going on in European banks and their lending to non-banks? Can't say for sure, but it does suggest there is something. I talked about the shenanigans that are happening with US banks and what's going on in their balance sheets. Did a video on that just a few days ago. That's the one link below. As always, thank you very much for joining me. Check out Eurodollar University Spring Sale. Thank you to all the members and subscribers, especially the new members and subscribers. And until next time, take care.